There's exactly £22.40 of tax-free space between the full new state pension and the personal allowance this tax year. That gap is so narrow that most pensioners look at it and think they're fine. Just below the line, nothing to worry about. But HMRC isn't only looking at your state pension. It's looking at everything. Your private pension, the savings interest from that fixed-rate bond that matured last year, maybe a few hours of part-time work. It adds all of that together to estimate your total income for the year. And when that estimate is too high, which happens far more often than most people realize, your tax code changes without warning, and you start paying more tax than you actually owe. The scale of this is real. Pensioners across the UK are collectively overpaying millions of pounds in income tax every year. Not because of fraud, not because of any deliberate mistake, but because HMRC's estimated income figures don't match what people are actually receiving. In this video, I'm going to show you the one online step that can stop that overpayment in under 10 minutes. Then I'll walk you through 2 more actions that help you recover any tax you've already lost. If you're a pensioner who wants to keep your retirement income where it belongs, subscribe now. I put out videos like this every week. So where does this overestimation come from? It's not HMRC being malicious. It's just the way the system is built. Understanding the mechanism behind it makes the fix obvious. When you first start receiving the state pension, HMRC automatically adds its annual value into your total income estimate. Right now, the full new state pension is £12,547.60, just £22.40 below the personal allowance of £12,570. If that's your only income, you're in the clear. But most pensioners have other income coming in alongside it. If you receive a private pension, your tax code is the mechanism HMRC uses to collect any tax owed on your total income. Your private pension provider receives an instruction from HMRC, a code telling it how much to deduct before paying you. You never see the underlying calculation. You just see the net amount arriving in your bank account each month and assume it's correct. The problem begins with the other income sources HMRC also includes in its estimate: savings interest, dividends, rental income, part-time earnings. These are all estimated, and those estimates are typically based on the previous tax year's figures. If your income situation has changed, which in retirement it often does, those figures can be significantly wrong. Let me make this concrete. You have the full new state pension of £12,547.60. You also receive a private pension of £8,000 a year. That puts your total at £20,547.60, £7,977.60 above the personal allowance. HMRC adjusts your tax code to collect basic rate tax on that excess. At 20%, that works out at roughly £1,595 for the year, which is about £133 a month coming out of your private pension. So far, that's correct, but last year a fixed-rate bond matured and you earned £2,000 in interest. You declared it. HMRC logged it. And now, for this tax year, the system assumes you'll earn the same again, even though the bond no longer exists. So your estimated total income becomes £22,547.60, and your tax code adjusts again to collect more. You're being asked to pay tax on income you're not receiving. I'll be honest with you. The first time I saw my own tax code change without any explanation, I panicked. I called HMRC, waited nearly 40 minutes, spoke to 2 different advisors, and got a different answer each time. I came off the phone more confused than when I started. That frustration is what drove me to understand how the online system actually works, because it turns out the fix is much simpler than the problem suggests. The deeper issue is that HMRC's system is built for scale. It runs on patterns and prior year data, not on the individual nuances of your retirement. But retirement income isn't like a salary. Bonds mature, interest rates shift, part-time work stops. Every time something in your life changes, HMRC's estimate can drift further from your actual income. Leave that drift in place and the cost is straightforward. You overpay, quietly, month after month, until HMRC reconciles the figures at the end of the tax year. You might receive a P800 and get a refund. You might receive a simple assessment asking for more, or the error just sits there, unrecognized, for longer than it should. There is a better way, and it starts with a single online step. The most powerful thing most pensioners don't know about is that HMRC's personal tax account lets you view and update the income estimates they hold for you. Not just look at them, actually change them. And for savings interest specifically, the whole process is digital. No phone call, no letter, no waiting. The process has 4 steps and it takes about 10 minutes in total. First, go to gov.uk and search for Personal Tax Account. Sign in or register if you haven't done so already. You'll need your national insurance number and a form of identification. Second, once you're logged in, navigate to check your income tax and look for estimated income. This is the page where HMRC shows you the exact figures it's using to calculate your tax code. Third, if you see a savings interest figure that was a one-off last year, from a bond that's matured or a high-rate account you've since closed, select that income source and enter the amount you actually expect to earn this tax year, not last year's figure, this year's actual expectation. Fourth, submit it. HMRC will recalculate your tax code and send the updated version to your pension provider within a few days. Now let's put a number on what that 10 minutes is actually worth. Say your previous estimated savings interest was £2,000. Your actual expected interest this year is £500. When you correct that figure, you've reduced HMRC's view of your taxable income by £1,500. At the basic rate of 20%, that saves you £300 in tax for the year. But it's actually better than that. The personal savings allowance means basic rate taxpayers can earn up to £1,000 in interest each year without paying any tax on it at all. So if your actual savings interest is £500, you owe nothing on it. The allowance covers it entirely. The saving isn't just £300. It's every pound HMRC was incorrectly collecting on income that was never taxable in the first place. I used to think that fixing a wrong tax code meant calling HMRC or posting a letter and waiting weeks for a response. I was wrong about that. The online update is faster, it leaves a clear digital record, and it works without any of that friction. I wish I had known this 5 years ago. It's worth being clear about what you're doing when you use this. Your personal tax account is exactly that, yours. HMRC maintains it, but the estimated income data belongs to your situation. Reviewing it and correcting it when the figures are wrong isn't aggressive and isn't risky. You're simply telling HMRC what your income will actually be, so your tax code reflects reality rather than last year's guess. Updating your estimated income is the single most direct action you can take. But there are 2 more steps that complete the picture, and together, all 3 protect your retirement income, both going forward and for what you may have already lost. Let's walk through each of the 3 actions clearly. They build on each other, and working through all 3 is what makes the difference between a temporary fix and a lasting one. The first action is to check your tax code. Log into your personal tax account and look at the estimated income HMRC is using for the current tax year. Compare those figures to what you actually expect to receive, your state pension, your private pension, your savings interest, and anything else. Then look at the code itself, focusing on the letter at the front. The most common code for pensioners is something like 1257L, which represents the standard personal allowance being applied to that income source. But some codes point to a problem. A K code means HMRC believes you owe more tax than your allowances can cover, so it's adding that amount onto your taxable income rather than reducing it. A BR code means all of your income from that source is being taxed at 20%, with no personal allowance applied at all. A 0T code is an emergency code. HMRC doesn't have enough information about your situation and has applied a default rate. If you see any of those and they don't match your circumstances, that's your signal to move to the second action. The second action is to update your estimated income, and I've already described how to do that. Focus especially on savings interest and any income that was one-off in nature. If you had dividends from a holding you've since sold, update that too. For rental income or self-employment earnings, the online update may not cover every source, and in those cases you may need to contact HMRC directly. But for savings interest, the most common source of estimated income errors in retirement, the fix is entirely online. One thing I want to say clearly, most people stop after the first action. They see a code that doesn't look right, they assume it must be complicated to fix, and they move on. That assumption is what keeps costing them money. The code looked wrong because it was wrong. But they didn't act, and the overpayment continued for months. The year my own fixed-rate bond matured, my tax code changed to a K code. I didn't notice it straight away. By the time I looked at the numbers properly, I'd lost roughly £80 a month for 3 months, around £240 in total. Money I'd paid in tax that I never legally owed. The fix took about 10 minutes online. That's 10 minutes versus £240 out of pocket. Lesson learned, and I'd rather you didn't go through the same thing. The third action is to claim back any tax you've already overpaid. If your code was wrong and too much tax was collected through PAYE, you're entitled to a refund. In many cases, this happens automatically. HMRC sends a P800 at the end of the tax year, which calculates whether you've underpaid or overpaid. If you've overpaid, the letter explains how to claim. But you don't have to wait until April. You can use your personal tax account during the year to check your income tax position and submit a refund request, or you can contact HMRC directly. Most refunds are processed within a few weeks. If you've contacted HMRC and haven't had a resolution after 30 days, you can escalate to the adjudicator's office, a free independent service that handles disputes between taxpayers and HMRC. 3 actions. Check your code. Update your estimated income. Claim back what you've overpaid. None of this requires a financial advisor. None of it costs you anything. But most pensioners don't know all 3 are available, and many are paying a quiet price for that gap. Knowing what to do and actually doing it are 2 different things. The gap between them is worth talking about. There's a reason most people don't log into the personal tax account even when they know they probably should. It isn't carelessness. It's something that looks a lot like caution. When you've spent decades being careful with money, when you've learned the hard way that mistakes have real consequences, the idea of entering a government system and changing official figures feels uncomfortable. What if you enter the wrong number? What if HMRC comes back with questions? What if you make something worse? Those aren't irrational concerns. They're the reaction of someone who takes their finances seriously. But there's a name for the pattern those concerns produce. Behavioral economists call it status quo bias, the tendency to keep things as they are, even when doing something would clearly be better, because change introduces uncertainty and inaction feels like the safer choice. The problem here is that inaction isn't safe. It's expensive. Doing nothing means continuing to pay tax you don't legally owe. The risk of updating your estimated income is genuinely low. You're not making an irrevocable decision. You're correcting an estimate that was based on last year's data. If HMRC disagrees with your figure, they'll raise a query and you'll have the chance to explain. This isn't a formal tax return under penalty. It's simply providing a more accurate picture of what you expect to earn, which is exactly what the system is designed for. If the idea of making changes still feels like too much, try this. Give yourself 15 minutes and open the personal tax account. Don't change anything on the first visit. Just look. See what HMRC's estimated income figure says. Compare it to your actual expectation. That single step is already meaningful, because most pensioners have never seen that number, and many would be surprised by what's there. I don't know every detail of your situation, and I can't promise this applies identically to every person watching. But for the majority of pensioners receiving a state pension alongside a private pension and some savings income, reviewing and correcting that estimated income figure is the most practical step available, and the one most likely to make a real difference. Once it's done, your pension provider collects the right amount of tax automatically. You don't need to do it again unless your income changes. The effort is small, the benefit lasts. Let's bring this together. The trap is straightforward. HMRC estimates your total income each year, typically based on what you earned the year before. When your income changes, and in retirement, it often does, that estimate falls out of step with reality. Your tax code adjusts to collect more than you owe, and you start losing money you should be keeping. The fix is equally straightforward. Your personal tax account at gov.uk gives you access to those income estimates and the ability to correct them. For savings interest, the update takes around 10 minutes and doesn't require a phone call. Fix the estimate, and HMRC recalculates your tax code. If you've already overpaid, you can claim it back through your account or by contacting HMRC directly. The mindset that makes this work is simple. Doing nothing is not the safe option here. The system isn't designed to penalize you. It's built to process millions of people efficiently, and at that scale, individual changes in income don't adjust automatically. Understanding how to correct the estimates yourself is how you step outside that process and take back control. Protecting your retirement income doesn't always mean complex financial planning or expensive advice. Sometimes it means 10 minutes on a government website, correcting a figure that was based on last year's data. That's what all 3 actions in this video come down to. If you found this useful, subscribe to the channel. I make videos every week for pensioners and near retirees in the UK, not to alarm you, but to give you the clarity and confidence to protect what you've worked for. The system isn't working against you, but it isn't automatically working for you either. Now you know how to make it work in your favor. You're in control.